Welcome back to Gold Rush Reporter. I'm your host and gold analyst, and today we're taking a closer look at something fascinating happening in the Kati silver market. At first glance, what's coming next for silver might sound like bad news. Prices could soften, volatility might rise, and headlines may scream silver slump. But in reality, this short-term normalization could open one of the most strategic buying opportunities we've seen in years. So, what's next for silver? Well, that depends entirely on your time frame. In the next few weeks, the market looks set to stabilize. We're seeing silver prices trying to find their balance after a series of heavy blows. This isn't the collapse some people fear, it's a market reset. And those who understand that may come out on top. Here's the key. Silver markets are normalizing, and that process gives patient investors a window to build their positions. As prices consolidate, the emotional crowd may panic, but disciplined stackers can use that moment to accumulate more silver at more favorable levels. Now, let's be clear. Timing the market is almost impossible. Not just for silver, but for any asset. That's why serious investors use dollar cost averaging instead of emotional buying. You don't buy because you're scared of missing out, and you don't sell because of panic online. You make decisions based on long-term fundamentals, not short-term noise. That's why I always tell viewers, do your own research before you buy or sell. Study different viewpoints, verify sources, and understand your personal goals. Even though this channel is sponsored by bullion dealers and industry partners, my mission here is to give you insight, not hype. Now, as we record this, silver has taken another hit in the overnight markets. Prices have dipped, sentiment feels weak, but under the surface, something more important is happening. The system is beginning to rebalance. After months of volatility, we're entering a phase of consolidation. Think of it as a market catching its breath before its next move. When silver prices compress like this, history tells us that it often builds the base for the next leg up. And that's exactly what might be forming right now. To understand why, we need to look deeper into what's driving this so-called normalization, from supply inflows to changes in global demand. Because once you see the bigger picture, you'll realize that this isn't the end of silver's story. It's the calm before the opportunity. So stay tuned, because in part 2 tunes, we'll dig into what's actually happening behind the scenes. From London vaults flooding with metal to India's shifting demand patterns, and what all of this really means for the next phase of silver's journey. This is Gold Rush Reporter, and we're just getting started. Now that we've set the stage for what's happening in the silver market, let's get into the real mechanics behind this normalization phase. Because once you understand the moving pieces, the bigger picture starts to make perfect sense. First, let's talk about what's happening in the London bullion market. Over the past several months, we've seen an increase in silver inflows to the London vaults. That might sound alarming at first. More supply entering the market often translates to downward price pressure. But here's the catch. This influx doesn't necessarily mean people are dumping silver. In many cases, it's part of a short-term cycle where institutional investors are reallocating or rolling over contracts in response to interest rate expectations. Think about it this way. Silver doesn't just move because of jewelry or industrial demand. It's also heavily influenced by macro factors like the US dollar, bond yields, and monetary policy. When yields rise, investors move toward interest-bearing assets, temporarily putting pressure on metals. But as soon as those yields start to level off or fall, silver becomes attractive again because it doesn't carry counterparty risk. Now, let's connect that with what's happening in India. Indian silver imports have been volatile this year, swinging between high surges and sudden drops. When prices spiked earlier, demand cooled off. But now that prices have eased, we're beginning to see renewed interest from the Indian market, especially in the jewelry and manufacturing sectors. Historically, India's buying behavior often acts as a leading indicator for physical demand recovery. Meanwhile, in the United States, physical premiums have started to narrow. That means retail buyers, especially those purchasing silver rounds and bars, are finally getting better deals compared to 6 months ago. The panic premiums we saw in 2020 and 2021 are no longer there. This signals a healthier, more stable physical market where investors can build positions without paying overinflated margins. But there's another story here. And it's not just about short-term sentiment. While silver's paper price seems weak, physical supply chains are tightening. Many refiners are operating close to capacity, and mine production hasn't been increasing enough to meet long-term industrial growth. So, when the market normalizes and the paper side of silver cools down, the physical side quietly strengthens. This is the hidden opportunity that patient investors recognize. While everyone else focuses on charts and headlines, long-term stackers are watching fundamentals. Things like energy transition demand, green tech expansion, and global monetary shifts. For instance, silver remains a critical metal for solar panels, EV batteries, and tool electronics. Each of these sectors continues to expand, especially as countries push toward renewable energy targets. That's not just temporary hype. It's a long-term trend. So, what does this mean for us right now? It means we're in a buy zone of patience. Prices may still fluctuate, but every dip offers another moment to accumulate wisely. Not emotionally, not recklessly, strategically. In Part 3, we're going to dig even deeper into the macro side, the US dollar's strength, Fed policy, and how geopolitical risks could flip the silver narrative completely. Because remember, normalization doesn't mean the end of the cycle. It often means the beginning of the next one. This is Gold Rush Reporter, helping you see beyond the price and into the opportunity. When we talk about silver's current normalization, we can't separate it from the broader macroeconomic picture. Because no matter how much physical silver you hold, its price still moves within the global system of money, and that system is now at a crossroads. Let's start with the US dollar, the anchor of all major commodities. Over the past few months, the dollar index has remained surprisingly strong. That strength has been fueled by high US interest rates and the perception that the American economy is still resilient. But there's a catch here. Strong on the surface doesn't mean stable underneath. Debt levels are climbing, fiscal deficits are growing, and central banks worldwide have been diversifying away from the dollar at record pace. This shift is subtle but powerful. Nations like China, Russia, and even parts of the Middle East have been increasing their gold reserves, reducing reliance on US treasuries. Silver, while not directly part of central bank reserves, benefits indirectly from this process, because as confidence in fiat currency weakens, investors look toward real, tangible assets. At the same time, the Federal Reserve's policy plays a crucial role. After 2 years of aggressive rate hikes, inflation has cooled slightly, but not completely. The Fed now faces a dilemma. Keep rates high and risk recession, or cut them and risk reigniting inflation. Either decision sets off a chain reaction. If they hold rates high, silver might stay under pressure short term. But if they pivot, even slightly, that could spark a major rally across precious metals as investors anticipate renewed liquidity. Remember, silver doesn't just respond to inflation, it responds to expectations of inflation. When people believe money will lose value faster, they move into metals early. That's why the biggest silver rallies in history began before inflation peaked. Now, let's connect this to the geopolitical landscape. Rising tensions in Eastern Europe, the Middle East, and Asia are reshaping trade flows and pushing countries to seek financial independence. That means more local currency trade agreements and less dollar dominance. In this environment, commodities like silver become more than investments. They become strategic reserves. On top of that, industrial and monetary factors are merging like never before. Silver is one of the few assets that sits at the intersection of technology and money. It's a metal essential for modern industry, but it's also a centuries-old store of value. That dual identity is what makes it unique, and what gives it asymmetric upside when the global economy enters periods of uncertainty. So right now, as normalization continues, smart investors are not panicking. They're observing. They're tracking how energy markets, bond yields, and currency shifts interact with silver's movement. Because all these moving parts are leading us to a turning point, one where silver could reprice sharply once the Fed blinks or the dollar weakens. In our Part 4, we'll move from the macro scene to the market psychology, exploring why sentiment in silver is so fragile and how that creates opportunity for disciplined investors. Because as any veteran analyst will tell you, when the crowd loses interest, that's when the real setup begins. This is Gold Rush Reporter, breaking down the layers behind the market's calm surface. When we move beyond charts, data, and fundamentals, what really drives short-term market action is psychology. The collective mindset of traders, investors, and even institutions. And in the case of silver, sentiment often swings more violently than the metal itself. Right now, we're sitting in a classic phase of what I call emotional fatigue among silver investors. After months of sideways trading and failed breakouts, many retail buyers have grown impatient. Some are even liquidating their positions at small losses, convinced that silver has lost its momentum. But this is exactly the phase that often precedes accumulation by smart money. Let's think about what happens in cycles. When enthusiasm is high and silver pushes toward $50, everybody suddenly becomes a silver bull. Social media fills with price predictions and people start chasing momentum. But when prices pull back, like now, silence takes over. The crowd loses interest. Yet this apathy is what creates value zones for long-term holders. Institutions and high net worth investors know this dynamic well. They accumulate quietly during these calm phases, taking advantage of retail exhaustion. That's one reason we often see large inflows into ETF holdings, or physical silver purchases reported by major dealers even when prices look weak. The public sells, professionals buy. Another important aspect of market psychology is anchoring bias. Many investors anchor to the last big move. In silver's case, the sharp run from $24 to $55 during the last rally. So when the price sits near $40, it feels low. But context matters. Adjusted for inflation, $40 silver today is equivalent to $25 silver a few years ago. That means the market may be undervalued relative to macro trends, not overvalued. We also have to remember that silver is a high volatility asset. It moves faster and more dramatically than gold, because its market is smaller and more speculative. That volatility discourages conservative investors but attracts traders, and that mix keeps sentiment unstable. However, long-term investors who understand this use volatility as a tool, not a threat. They average down strategically and build exposure when fear dominates the market. If we look at the current emotional temperature of the market, we can see signs of capitulation but not panic. Forums, dealer reports, and social media discussions show frustration but not despair. This middle ground, not euphoric, not fearful, is typically the calm before the next leg up. As a silver analyst, I see these behavioral shifts as signals rather than noise. When speculative traders leave the scene, liquidity drops, and that's when even small buying pressure can cause large price reactions. That's why the next silver rally might not start with big headlines. It'll likely start quietly, unnoticed by the majority, and then accelerate once confidence returns. In Part 5, we'll go deeper into the strategic positioning. How investors can practically navigate this market, from accumulation tactics to timing the next breakout zone. Because understanding psychology is step one. Acting on it with discipline is where the real opportunity lies. You're watching Gold Rush Reporter, where we decode the mindset behind the metals. Now that we've discussed silver's price psychology and market behavior, let's focus on what this actually means for investors, the strategy. Because understanding the data and emotions is one thing, but knowing how to act on that information is what separates successful stackers from reactive traders. Let's start with positioning. When markets are stabilizing, like what we're seeing now around the $40 zone, it's not the time to go all in, but it's also not the time to sit out completely. Smart investors approach this with a layered buying strategy. That means buying small amounts at regular intervals, dollar cost averaging, to smooth out volatility and avoid chasing momentum. Dollar cost averaging has one big advantage. It takes emotions out of the equation. Instead of worrying whether silver is going to $38 or $45 next week, you just keep accumulating based on your conviction in its long-term value. Remember, short-term movements don't define your success. Your consistency does. The second part of the strategy is understanding your time horizon. If your goal is short-term trading, silver might frustrate you. It's unpredictable and can whipsaw between gains and losses in a matter of hours. But if your perspective is long-term, looking ahead 1, 3, or even 5 years, these dips become opportunities instead of setbacks. Now, let's talk about hedging. Many analysts focus purely on physical silver, but in a modern market, you can use a mix of tools, from ETFs to mining stocks, to balance your exposure. Physical silver gives you tangible security and independence from the financial system, while ETFs or miners offer liquidity and growth potential. Combining both gives you flexibility. Another smart move is to track macro triggers. Watch central bank activity, especially regarding interest rates and gold accumulation. Lower interest rates tend to support silver because they reduce the opportunity cost of holding metals. Similarly, when central banks increase gold reserves, silver often follows, even if at a slower pace. We should also watch industrial demand trends, particularly in green technologies. Silver plays a key role in solar panels, electric vehicles, and high-tech electronics. Even if jewelry or investment demand slows temporarily, the industrial sector can pick up the slack and sustain prices. This diversification of demand is what makes silver such a unique asset. It's both a monetary metal and an industrial one. Lastly, patience is your most valuable weapon. Every major silver rally in history started during a period of boredom and disbelief. The same people who give up today will be the ones chasing the market when it moves again. So staying disciplined, informed, and steady is essential. To sum it up, accumulate gradually, stay diversified, monitor global trends, and focus on long-term conviction. Silver isn't just a trade, it's a strategic hedge against currency instability and geopolitical uncertainty. In our final part, we'll wrap this up with the broader outlook, how silver's next phase might unfold, and what that means for those who held through the turbulence. And of course, we'll close with a message from your trusted analyst here at Gold Rush Reporter. Stay with me. The conclusion might just change the way you look at silver altogether. So here we are, wrapping up this deep dive into the silver market. Throughout this discussion, we've seen how normalization, sentiment shifts, and global macro forces are shaping silver's next chapter. And now, as we step back to look at the bigger picture, one thing becomes clear. This market is preparing for its next move. In the short term, silver might stay range-bound, hovering near that $40 support level. We could see small dips into the $39 or $38 zone, but those are likely temporary. This phase isn't weakness, it's consolidation. Every strong rally in precious metals begins with a phase like this, when investors lose patience and the price settles quietly before momentum returns. As we move forward, several key drivers will determine how silver performs. First, interest rates. Lower rates will support higher silver prices by reducing the cost of holding non-yielding assets. Second, industrial demand, especially in solar energy and EV manufacturing, will play an increasingly vital role. These sectors aren't slowing down. They're expanding rapidly, and silver remains irreplaceable in those technologies. The third major driver is geopolitical risk. With global tensions still high, from Eastern Europe to the South China Sea, investors will continue to look for safe haven assets. Gold typically leads that movement, but silver follows closely behind, often delivering stronger percentage gains once momentum builds. And let's not forget the psychological aspect. Many investors are sitting on the sidelines, waiting for confirmation before they buy again. But historically, the biggest gains go to those who act during uncertainty, not after the rally starts. That's why positioning early, even in small increments, can make a huge difference. If silver can hold above its current support levels and absorb short-term volatility, I believe we'll see a gradual rise toward $45, $50 over the coming year. It may not be fast, but it'll be healthy and sustainable. A move built on real fundamentals rather than hype. So, what's the takeaway for long-term holders? Stay patient, stay informed. Don't get distracted by daily fluctuations. The big picture still favors silver, not as a quick trade, but as a strategic long-term asset. If you've stayed with me through this full breakdown, I want to thank you for being part of the Gold Rush Reporter community. My goal is to help you see these markets not just through headlines, but through the eyes of an analyst, clearly, calmly, and with conviction. If you found this analysis useful, make sure to like this video, share it with fellow stackers, and subscribe to the channel for more insights on gold, silver, and the broader economy. Drop your thoughts in the comments. I read every one of them. Until next time, this is Gold Rush Reporter, your trusted gold and silver analyst, signing off. Stay smart, stay strategic, and keep stacking with purpose.